Welcome back, everyone in YouTube land. This is your tinfoil hat economist coming back to you at the speed of light with episode number 12, Investing in the Age of a Global Malady. Well, let us review recent events. We see that the stock market has fallen 33.9% as measured by the S&P 500 from February 19 to March 23, and we come back about 18% after that last week. And so what lies ahead? Well, I have to mix my metaphors for you, but first I have to take this off so I can breathe. I will mix my metaphors for you and say that the second shoe has yet to drop on the four-legged bull market, bear market. I think we're down around 20-25%, depending which index you want to look at, and we're halfway there. The graphics department is home in self-isolation, so I will reuse this old graphic, but still accurate. And there you see previous recessions and related bear markets, down 48% in 1973 to 74, 49%, 2000 to 2002, and then a 56% drop 2008-9. We're halfway there. That's what I see. Now, why am I so gloomy? Well, the problem is we still have what are called naive populations in relation to the novel cold virus we call COVID-19. Now, unfortunately, Hong Kong had a lockdown and a quarantine. They tried to come out, and new cases began rising again. They went back into a quarantine, and now they've gone back into a full lockdown one more time. They're stuttering back and forth between lockdowns, trying to reopen, and then more lockdowns. Now, here in the United States, or in other developed nations, they're on lockdowns. That appears to slow the spread of the virus. But then, what's the exit strategy? As soon as the lockdown is removed, people again mingle, you'll start to see COVID-19 cases go back up. And I don't think there's the will on the part of the public or public authorities to say, sorry, we're just going to have to absorb several 100,000 deaths in order to restart the economy. It's a very grim decision to make. No one wants to make that decision. We all probably feel in our hearts no one should have to make such a decision. But life is cruel. We can either sustain the bear market and an economic recession for a couple years, or hope for a virus and a vaccine in a year, or we can bite the bullet and come out of lockdowns at some point in the future. And at every point we try to come out, if we still have a naive population, that is, no herd immunity, people haven't gotten the virus and shook it off, and no vaccine, you will have a naive population. So let's look at gold. Gold has been very squishy for the last 2 months, still around $1,600 an ounce. Now in the old days, they sold gold as a hedge against inflation. It turned out not to be a hedge against inflation and to not pay dividends and interest along the way. We all know, seen from previous charts I've shown on these videos, gold peaked in 1980 and has wiffle-waffled down and sideways and up a little bit ever since. Maybe for the next year, since I predict equities have another haircut coming and gold might waffle sideways, maybe you want to stay in gold for the next year. But I wouldn't look for great things from gold. And the news out this week is that the Russian central bank is no longer buying gold. One of the oddities of the gold market is that prices are somewhat artificially held up by purchases from the Russian central bank and the People's Bank of China. And if those two central banks stop buying gold, in addition to jewelry buyers in India and China reducing purchases of gold, which they sometimes purchase as an investment, gold could have a long and southerly slog ahead. Well, what can you do? Well, you can short various markets, or you can go into cash. We'll discuss further options in episode number 13, and I hope to see all of you again. So this is your tinfoil hat economist signing off at the speed of light, and I look forward to seeing all of you again in episode number 13.